Hey, good morning and welcome. This is a really good day today, and it's a Saturday, and we've got the rain is gone here in San Diego. And what we're going to do is get started and talk a little bit about rental real estate. And what I'm going to do today is just give you some ideas about sort of the approach that you want to look at when you're investing in real estate. There's a whole variety of different ways to enter and exit into real estate. And I thought that this would be very useful given that we've had some major changes in the tax codes. And with the COVID thing, a lot of things have started to change, and we're starting to see some of that effect in the market with interest rates and property prices. And, if you've got rentals right now, you probably want to look at some of this stuff and just sort of go down a checklist and kind of check in and see where you're at. What we're trying to do right now is just frame the discussion about some of the high point issues. These are things that, in my experience as a tax expert, is that these oftentimes get overlooked until after the transaction has closed, whether it's on the buy side or the sell side. And so I thought it would be very useful to give some of those highlights and drill down a little bit. And I'll talk about a little bit of the resources that are available to you and give you a site. It'll scroll along the bottom of the screen there. And I think for the most part, what I would like as an outcome is at least a new awareness or an increased awareness about where you might be or where you might be going in terms of adding real estate or building on the real estate that you might have as part of your investment strategy. We're going to cover about 40 minutes, 45 minutes, give or take a little bit. And the topics that I'm going to go through, we're going to talk about what type of investor are you? That's really important. It comes down to really two things. You're active or you're passive. And you can sort of be a little bit of both. And we want to talk a little bit about that. That's going to control some of your financial outcomes. And certainly those are going to be guided by some of your tax impacts. The type of property, is this going to be a property that you're flipping or you're holding, right? The tax implications and financial implications and modeling are going to be very different between those two character types of properties. And so when you're modeling your investment in the real estate, it's really important to identify these things as sort of your intention and your desire for that kind of an outcome, and making sure that all of those things are lined up financially to give you the highest amount of reward with the lowest amount of risk. The type of rental property, we're going to be focused on single family residential and units from 2 to 4 units. That's a very popular niche that continues to outpace the market in terms of price, value, cap rates, return on investment. And so it really is an area that I think we're going to see continued growth, both here in San Diego and a lot of other places around the country. We're going to talk a little bit about your holding period, particularly if you're going into a property and you're just going to flip it. The implications financially that are going to be somewhat driven by the tax implications are going to be very important. That's an opportunity to have a really good return on your investment, but it's also an opportunity to dilute that return in capital gains exposure and in terms of tax exposure. And so we want to talk a little bit about how the holding period can play a big important role in that. We're also going to talk about financial modeling. It used to be back in the day, you'd have an investment plan, maybe a real estate plan, maybe a business plan. All of that has changed with the economy and us moving from a mass society to a network society. And the new way of doing things that we're discovering is really modeling. Modeling is much more dynamic. It's more in real time. and takes into account a lot more of the variables that we often may have an occasion to overlook. So we're going to be talking about financial modeling. Targets, your target buyer if you're flipping, or maybe you're holding for a shorter period and then you're going to sell, and a target tenant. We're going to talk a little bit about targeting tenants based on demographic profiles, generational profiles, and market proximity of where the property is located, because we're seeing this mass shift in almost every community around the country, largely due to state and local tax policies and largely due to COVID. People are finding out that they don't have to go in and do that 8 to 5 Monday to Friday gig. They can actually work remotely. Imagine that. Holding period, again, I'm going to come back on holding period because there are a couple of little financial traps. Some of them are tax related that could get you sideways if you're not aware that your holding period is a really important key part of financial success. Remember, financial success, the way defined, is winning the game. And winning the game is measured in how much profit that you're making pre-tax and post-tax, before tax and after tax. And that can be a pretty big gap if you don't have the efficient or effective modeling in place. Vesting of property is a really big deal. This is for not only estate planning, but for the unexpected life events, death or incapacity, and how basis is computed. If you're holding property with a spouse and you have a premature death of one of the spouses in the marriage, then you're going to have some impacts that you definitely want to be aware of in working with your attorney, maybe updating your living trust and maybe your living will and a few other things. And then we're going to talk about the exit plan. You know, going into a deal, you should really consider having a plan of how you get out of the deal and what that's going to look like. And then how does your modeling account for any of the impacts that you might have? Is it going to push you into a higher tax bracket? Is it going to be a sale and you're taking the proceeds into another property? Or maybe you're going to develop an appetite for 1031 tax deferred exchanges. And so these things are now becoming more important, a lot of it driven by the economy and a lot of it driven by the dynamics of real estate continuing to grow. I think the last time we really saw these kinds of opportunities was during the second term of Reagan. And in that period of time, there were major changes in the tax codes. And then we saw a resurgence going into the 90s that led to a lot of reshifting of people in how they were going into and holding residential rental real estate. So in terms of that, then I'm going to scroll on the bottom here, a website that you can go to for resources. I've got a copy of a free book that I wrote that you can download a copy. You don't have to go to Amazon and buy it. You can get a copy of it today for free. If you're looking at using rental property as part of your retirement plan, I do want to mention a few things before we conclude today and give you some ideas that you might want to be thinking about talking with your financial advisor, maybe your tax advisor, and maybe your attorney, because those opportunities are starting to develop into some really great key plays that you can take advantage of if the property is going to be part of your retirement planning. And then we're going to talk about a little bit about should I pay off the mortgage if I'm going to hold it for a long period of time? There are two financial considerations. And if you're creating the financial modeling, there's an analysis that can be done that will tell you, the cost benefit of making that decision. When you're creating an effective real estate model, it's sort of like what Warren Buffett says, right? I love that saying. I believe it was attributed to Warren Buffett. There's two rules in investing. Rule number one, don't lose money. And rule number two, when you get confused, refer to rule number one. And I thought that was kind of clever because I only have to remember one of the rules, right? And real estate's sort of the same way in that, yes, you want to make money, but the dynamic of making money comes from the character of the property as a financial unit and its tax attributes. And it comes also as part of what your objective, what your outcome is. If your property is set up financially and your modeling is set up a certain way, but it's not consistent with your longer game plan, then you're going to have inefficiencies that actually can be measured, and those inefficiencies can create financial impacts both today and in the future. And so one of the reasons that modeling is so important is that it gives you the ability to pivot and adjust on the conditions economically and be more dynamic in your long-term planning as part of that dynamic process. And then where to begin in the assessment. Where are you with regard to the property or your desire to get into the property? Where are you going, and how are you going to get there? And then I'll talk a little bit about the resources. So let's start right now with the type of investor. There's generally two types of investors, one that is passive and one that is active and material in the participation. You're out there. I don't know that you're actually swinging the hammer kind of thing, but you're more engaged and you meet certain rules that are in the tax regulations that allow you to take advantage of the tax losses being classified as ordinary losses. Then they offset ordinary income. If your activity is classified as a passive activity, then your losses are passive. They have limitations. We call it PAL, P-A-L, passive activity loss limitation, and they can only offset other passive gains. And so that's a big deal because what it does is it gives you some direct impacts financially, both in terms of your return on investment, your internal rate of return on investment, and your capital gains exposure at some point when you exit the property. Classifying the type of activity as passive or active material is pretty straightforward. It's a generally 5 or 6 little point test. And we go down and look at that based on the regulations and what your activity is doing. And that's going to guide your tax profile, but it's also going to impact your financial modeling. Tax losses are artificial losses in that, for example, depreciation. It's a recognized expense, even though you're not paying it directly out of your pocket. It is offsetting income. And so it's a very important part of the modeling process because it drives a lot of the benefits, both financially and in terms of tax, that allow you to maximize financially those financial outcomes. And so that's an important aspect that we want to always be looking at. The type of property generally in regard to residential rental, whether it's a single family or units of 2, 3, or 4 units, a duplex, triplex, or a fourplex, is really in 2 categories. You're acquiring the property and you're going to flip it, which means generally your holding period is going to be 1 year or less. Generally, your capital gains are going to be short-term gain rate, and how you pro forma your financial impacts and those that are tax related are going to have a big influence on the amount of net dollars that you end up keeping after you take into account the tax exposure. And flipping real estate has with it some upside that's really big. If you structure the deal correctly, you can have a pretty good return on your investment. However, not recognizing or paying attention to the financial modeling aspects, particularly those that might be driven by the tax impacts, can dilute significantly, cut those profits as much as 50%, and give you an unpleasant surprise at tax time when you file your tax return, just because flipping real estate has some unique tax attributes that can often be an unpleasant surprise in the final outcome and in the analysis. If you're flipping properties, for example, and let's say that you're using LLCs as part of your overall financial modeling, which I'll talk about, and then let's say you've got one that you want to hold for longer than 1 year. You generally don't want to mix your peanut butter with your chocolate. That's my analogy. You want to have those separate in different LLCs because of the tax attributes being a little bit, actually a lot in some ways, very different in terms of how that's going to be accounted for. And so it gives you an opportunity to sort of bifurcate. This group of activity is really about flipping properties, and this group of activity is really about acquiring and holding properties and then later selling on an exit plan. And so that's really a key important part. I see a lot of opportunity for people to really do a lot more in that area, but I've also seen examples where people have sort of commingled and put it all in one LLC. And what happens is you can sort through that. You lose some of the dynamic, but what happens is you end up spending a lot of unnecessary time and money on fees for people to come in and reconfigure that. When if you just set it up a little bit differently on the front end, you're going to save yourself a lot of time, and you're going to save yourself a lot of money down the road in both today. The classification of property, it's sort of two levels. It's residential rental, that's its tax classification. And the type of property is a single family up to 4 units. That's a niche that we're looking at. Once you get to 5 units or more on a single property, the tax dynamics and the financial modeling, particularly your cap rates and things like that, dramatically change. And I've seen this time and time and time again. Your lending rules are going to change. Borrowing money on a 4 unit is going to be a lot different than borrowing money on a 5 unit, which is going to be deemed by the lender to be commercial property. And so the cap rates are looked at differently. Your financial analysis and modeling is done differently. And so all of the tax attributes are going to be affected by that. And if you're up there and you're looking and you're used to doing this single family gig or the 2, 3, 4 unit gig, and then all of a sudden you want to step up and maybe liquidate a couple of properties and go into a 6 or 7 unit, you're going to be doing a very different financial model, and you're going to be doing a very different tax impact model that you're going to want to work with whoever your tax advisor is. And if it's us doing it, we've got people that are expert in this area. It's really one of those areas that can give you a huge upside, but can also give you exposure to a huge downside in some unpleasant tax consequences. Let's talk a little bit about holding period, and we'll set flipping property aside because generally the assumption is that it's going to be a short period of time for capital gain purposes, less than 1 year. I will come back and address the issue about straddling. Straddling is a term of art in tax law that talks about one asset. Let's say it's going to be short-term capital gain, less than 1 year holding period. but your holding period straddles 2 tax years. You acquired it in 2020, and your disposition, you're getting rid of the property, is going to happen in 2021. Straddling tax years can have a big dynamic impact on your financial modeling and that analysis, and can also have some pretty dramatic impacts in terms of tax impacts, because the tax rules that applied when you acquired it may be different than the tax rules when you disposed of it, straddling those 2 tax years. And so that is always something that you want to do in running through that analysis before you actually close escrow, so you have a little bit more certainty about any of those unpleasant surprises. Or conversely, you may want to see some opportunity. It may benefit you. We just had a client recently that had a very similar situation, and we determined that the upside was greater to straddle 2 tax years, and the downside, or the risk of a downside in the property going down in value, was nil. So go ahead and straddle the 2 tax years in terms of how you're going to approach your entry and exit of the property. And I think that the important part of that is that part of it's going to be picked up in the first year, and the bigger part of it, the impact that you're going to recognize for financial and tax purposes, is going to be picked up in the next year. And you don't know what Congress or the state legislature is going to do with regard to the tax laws. And so there's a little bit more higher risk of uncertainty, because major changes could happen in Congress that took away previously held benefits or impose new tax limitations or adverse tax impacts in the current year. And so these things, again, are part of an analysis that you just want to know if it's impacting you or could potentially impact you, so that you have that information, and then it gives you more choices, right? I'm always in favor of having more choice, not less choice, and the more information that you have translates into giving you more choice. Moving on to financial modeling. There are really 3 parts to the financial modeling, and I like to use the analogy, you probably have heard me say this before, a 3-legged stool, because the cool part about a 3-legged stool is the 3rd leg. Without it, it's going to fall down. And so the 3 points of financial modeling is basically calculating and determining, once you acquire the property, calculating and determining what your adjusted basis. That is a term of art for tax purposes and financial purposes, because that basis number is really going to determine at the end, when you exit the property, it's going to determine some pretty big deals about what your actual net return on investment, what your return on capital, and what your after-tax return, internal return on investment really is. And you can think it's a great idea and you're going to have a bigger upside, only to discover that most of that upside is going to get gobbled up in unintended tax consequence or unintended financial outcomes. A tax consequence affects the outcome, because if you pay more tax, you have less money. And so conversely, you have a financial impact directly related to the tax modeling. The first part of financial modeling is really the adjusted basis, and not so much how you acquired the property, unless it was through an inheritance. Then the rules are going to be very different. So we're not going to talk about that today. Once we have the adjusted basis, the second part of the financial modeling is really your holding period, along with any improvements that are capital improvements, and what your effective cost in operating the property as a rental. Your effective cost is really calculated, simply put it, your gross rents minus your operating expense, and then minus your mortgage interest and property taxes. Once you have that, then you have a pre-tax adjusted profit. Then you have to calculate from that how much personal tax exposure that property is going to have. And if you're maximizing your tax benefits, and generally on a newly acquired property that you have maybe a 5 to 7 year holding period, you're going to have a big front end of tax benefits offsetting those rents that would generate tax losses because your deductions are going to be greater than your gross income or even your profit before you take those into consideration. There's a ratio in that second part that tells us if that is effective financially. It should meet a certain ratio of dollars as a percentage. And if it's not, then we can find why and where we need to adjust our financial modeling so that it gives you the maximum potential opportunity for the least expense and the most benefit, both today and in the long term. And so this is why financial modeling is now becoming much more dynamically involved with this type of an investment because it gives you a chance to look at one single property and then its contribution to maybe other properties that you have and how its financial performance is being measured in terms of its meeting your outcomes and objectives as an investor. The third part is the exit. And this is where it's really important because I think a lot of times we look at what we paid for the property. Let's just make it simple. We have an adjusted basis of $100,000, and then we're going to sell the property, let's say 5 years down the road for $300,000, and so we have a $200,000 gain. Then you have cost of sale, and then you have the actual money that you end up keeping from escrow. But there's another calculation, whatever that money is, then we have to add back to the profit. We have to add back any tax benefits like depreciation. That's called recapture. And you have to add that back to your profit and pay tax on that. That's the tax benefit rule. And then you have to then calculate, did that profit, since it's going to be long-term gain, did that profit push you up into a new bracket? We have a new bracket this year, right? Every year we get a new bracket. And they kind of tweak and fine-tune the tax rules such that it feels like, and it sounds like, and it looks like our tax rates went down, and they did. But what happens is that they expanded the base, and so you actually pay more money. It's kind of weird how that works. But it's a progressive tax system, so that's how that's set up. And so where people get really confused, even tax experts and financial experts get confused, is not realizing that extra $10,000, $20,000, $50,000 of profit pushed you up into a new bracket, and the tax on that new bracket is going to take half of your profit, the way that it was set up, and then you don't end up with as much money as you thought. Well, that's an easy fix, because if you have financial modeling done on the property, which is very simple, it's easy to do, you're going to know what those numbers are. And then just if you're going to sell it this year, then you can go by what the bracket rates are going to be this year. And you can actually, within reason, you can actually pretty narrowly calculate what that best case, worst case scenario of financial exposure is going to be. And I think that the cool thing about that is that before you make the decision, you're going to know the benefit or the consequence financially that you're going to realize and recognize on that transaction. That's part of a planning process, yes, but it's more integrated because you're working with your real estate professional, or maybe you're the real estate professional. You're working with your escrow, your title. Maybe you're working with your attorney, your accountant. You're working with a lot of people, your mortgage lender. Every one of those people are going to have some impact on the numbers that come out at the end of the day that are your dollars coming back as a return on your capital. And what we want to do is we want to make sure that at the end of the day, you're keeping legally as much of those dollars as you possibly can. But at the same time, we're not taking on unnecessary risk, financial or otherwise. And so it's always a good idea to make sure that you have an exit plan for your property or properties and what that's going to look like. I would even suggest if it's a long-term holding period for more than 5 years, you probably want to have a little bit more dynamic plan B. In case plan A kind of falls apart, you have this second level that always gives you sort of a backup. You ever have a backup plan? I used to have a backup plan, and some days it was like, where'd my backup plan go, right? I've had days like that. Backup plans are cool, but they're carved in clay, not in stone. So they're very flexible, and they should be able to be adjusted dynamically with circumstances that are going on the ground. And they should be able to still meet the outcome objectives that you have as an investor. After all, you're putting your capital at risk, and to some degree, the name of the game to win it is don't lose money and make some money, right? Making money is easy, but keeping it, that takes a little bit more engagement. And so we want to be a little bit more engaged. We want to pay attention to our property, right? At the end of the day, we want to pay attention. But if you don't know what to pay attention to, then you won't know what question to ask. You don't know what you don't know. And I hate being in that position where you ever wake up and you think, I don't even know what I know today, right? And then you've got to figure that out. Well, hopefully what I'm doing today is giving you the high points, the details, the steps, sort of a checklist, if you will. And if you can check all the boxes, you're good. Ace is up. You got it done and you're good. Go make some cash and be a happy investor and have fun. Also, if you're going to be an active investor, you should, particularly if you're in a state like California, where we have rules for everything, you should familiarize yourself with landlord-tenant rules, because you think the tax law is confusing. That's an area that you just go over the cliff. And landlord-tenant rules can get you sideways financially really quick. You're working with your insurance person, guy or gal, doesn't matter, and they have certain riders on your policy that can protect you against things that you don't realize. So you might want to talk to your attorney or a real estate attorney, landlord, tenant, and maybe get a free consultation, and then talk to your insurance guy or gal, because we have those riders on our policies, Susan and I. And I'm going to tell you, it's for the small dollars in premium. I can sleep at night and not worry about some of that shit happening. And then I got another problem, right? We've got enough problems. Don't need any more. And so I would certainly put that on my checklist. Talk to my real estate landlord tenant attorney. We joined the San Diego Apartment Association. Great, man, what a great organization. And what's cool about them is you can pick up the phone and you can call them, and they can get you an answer to a question like right now, right? Like not 2 weeks from now, like right now, 90% of the time. And what's cool about it is that they've got a whole covey of resources available from landlord tenant attorneys and people that just specialize in these areas. And because you're a member, you get like on the preferred list, right? You ever been on a preferred list, like a VIP list, right? You get the VIP list. And so what's cool about that is they're going to take care of you right now. We joined, I think, last year, and they're really, and Susan's a real estate broker. And so that was a benefit because she also belongs to the county real estate association. And so we've got a couple of resources that, man, they just give us lots of good information that really help us educate ourselves about what we're doing and how we're playing the game called real estate investing. And that's about winning, and winning is about keeping the money, right? Okay. So we don't want to get into, tenants are tenants, right? But I can tell you that today it's a lot different than it was even 5 or 6 years ago when we were renting, doing rental property. And what's different is that this working at home thing is different. Security cameras. We're going through this whole security assessment on all of our properties right now because it's kind of a big deal, and making sure that we have adequate lighting. And we just had our electrician go just redo all the outside lighting for sensors, and we got these cameras going in. And what's cool about the camera, I can get on the phone and I can look at the property right now, right? And that's kind of cool. Or it sends me a little warning. So we're putting some of those things in. And what's cool about that is that you got a recording that's up on the cloud. And let's say somebody did something that to the property, there's like a video, right? And it's like cool because now you can like give that to the insurance company and maybe to the cops, and then they get the bad guy, and then everybody's good except the bad guy. And then the next part of that would be just really understanding that tenant relations is really also some legal stuff. Your lease agreement should follow, at least here in California, the rules in the standard form with all the disclosures. I mean, my goodness, the shit you gotta disclose that you didn't even think about. And if you don't do those disclosures, that could be a problem. And so the cool thing is, if you don't know what they are, the apartment association or the real estate association will certainly give that to you. A good landlord tenant attorney, a guy or gal that does that gig, can get you up to speed in an instant. And if you don't have those in place, you may want to consider going back and amending your lease agreements and amending and getting the disclosures, and just have everybody kind of just check it off that it finally got done. So the part of that also is occupancy and use and quiet enjoyment. Those are all things that a good landlord tenant attorney will tell you what they actually mean. The presumption is in favor of the tenant, obviously, but landlords have certain rights and obligations. And so, if you've got a couple of units, or you got, a single family, and you got the local trash service, you got to make sure that you describe what the responsibilities of the trash service are in your lease agreement. Because I'm going to tell you, it's one of those things that, believe it or not, you can get sideways on, and then you have problems, right? And even if you win like the issue, you still got to pay somebody some money to like take care of it. It's like that's draining money out of your pocket. Better to be proactive and preventive on front end. The other part is that I think that's important is make sure you keep electronic copies of all of your paperwork, and maybe back that up. I can't tell you how important it is from the time you acquire it to the time you get rid of it. You just want to have every document, everything that you did, and a good history. You don't know when that's going to be important. I can tell you, doing audit work or appeals work, it's really important. One document and one fact on that document can turn the tide in your favor or against you. So just be real good and prudent about keeping all your paperwork. If you're using the rental property as part of your retirement plan, the question is going to be, in what way? In other words, are you accumulating properties, right? Accumulation, richest man in Babylon, right? And then at some point, you're going to liquidate and take that cash and maybe treat it like an annuity and have it give you the income in retirement. That's one way to do it. And generally, in doing it that way, has a lot more risk financially, and it also has a lot more risk in terms of the tax impact. So let's say retirement's 10 years out, man, you don't even know what the tax rules are going to be 10 months from now, let alone 10 years from now. So that's a little bit high on the high end of uncertainty. I certainly wouldn't give anybody an opinion about what to do or how to do it, because too much of that is uncertain. There would be so many disclaimers that it's subject to all these things changing. If you're going to hold the property for that long period of time, and then it's going to provide you from the rents, the income, you have to remember that it's sort of a declining balance approach. Your tax benefits decline every year because the class life of the property, and your rent is inclining every year, presumptively. And the gap between those two is more money that you're keeping and more money that is exposed to more taxes. And it is in the foreseeable future. The question is, will my tax rates be higher than they are today? Well, I can tell you, go back to the late 70s when they did all of these things with IRAs and retirement plans. And they said, if you put your money in that, in the future, when you take it out, it'll be taxed at a lower rate. Well, you know what? Bullshit. That did not work, because our rates are much higher than they were then. And so based on that history, I'm going to say in the future, it's probably going to be higher even yet. So you really want to look at taking a serious approach with a financial advisor, even an attorney, because this is going to have a dramatic impact on how you're setting up your estate and maybe your living trust and your will. And those things now have some new tax wrinkles to them also. So I would really step back and just kind of reevaluate the situation and make sure that if that is your plan, that everything lines up and is effective and efficient in being able to meet your outcomes and objectives. It's not something that you put on autopilot, right? It's like auto pay, auto shit. It's just like, man, everything's like auto. No, this is like a lot. This shit's serious. You got a lot of money, like in this property, right? And if it's going to give you an income, only to find out that most of it's going to get taxed, there's some things you can do, and there's some things that people would advise you to do in terms of a financial advisor, and certainly with an attorney in real estate, that would give you, a much better outcome long term. So be more engaged in that process and look to the horizon. You don't want an oncoming storm on the horizon that you can't see today. And failure to do that means that you're just adding more uncertainty. You ever have a situation where you're going through the day and then all of a sudden you just feel, man, I'm just so uncertain about what to do, right? Well, that's your brain basically telling you need more information, and you're getting that negative feedback of uncertainty. And what you want to do is you want to just sit down and figure out where you're at. And if you've got any gaps, let's just fill in the gaps. The checklist is a real good way of doing that. It's like, I don't know, probably 15 or 16 things that you go down and just check off. And I would probably do that like every year, right? Every year, just make sure you're checking it off if anything's changed. Let's talk about your market area and your demographic. I talked a little bit about this on a previous podcast, but as things happen, things change a little bit, and sometimes they change really fast. And what we're discovering more is that the area that your property is located in relation to other external amenities, community things, right? Walking, parks, major transportation, downtown. There's a whole list of things. Depending on the age group, like boomers are going to rent an apartment, they're going to have a very different thing that they're looking to or looking for in the area than, let's say, a Gen X or a Gen Y, a millennial. And the thing about that is, how do you determine what to charge for rent? The reason that that's important is that we're seeing a lot more narrow casting of rents based on these external amenities and features, or features and benefits. The direct ones that are related to your property, to give you an example, I think I talked about this on that last podcast. When Susan and I bought this last 4-unit, it's a hold property. It's part of our long-term plan. We went in and did a lot of stuff. We did a tear out on one of the units down to the studs and blah, 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 rebuilt everything and upgraded some of the other units. But what we did, what was cool, we came back and it had each unit had its like own separate meter and everything. But what we did is we put all of the utilities and everything, the water, sewer, trash, gas, lights, all of that in the name of our LLC. And when a tenant rents a unit, they get one price. They get one price that includes everything. And we're not that concerned about the electric because we're retrofitting and going with a solar install later this year. So they can, the light can go, right? Because our utility bill for electricity will drop 83%, just like our house. I think our electric bill for our house last year was $140 for the year, right? And so we got the tax benefits and we got the credits, the credits for the deal that we did. And the tenants are happy because they're all millennials, right? And they get one price. And it's about probably 22% higher than the whole area, right? And so the cool thing about that is we're getting a premium. That calculation was pretty simple. We went back to the person that we bought it from and looked at the prior years, 2 years, all those utilities, trash and gas and lights, San Diego gas and electric, and we added that up and then divided it by the square footage of each unit. And then we took a factor of I think we used 1.35. And we just multiplied that and added that to our new rent base, which had another factor in that. And it ended up that we're getting, I think one unit's like 26% more. The other units are about 22% more. And they get one price and it includes everything, right? And we got a nice little fruit tree there. They get some oranges and a nice laundry and they can use all of that. And we get a premium, which gives us just like a cool cap rate, and we're getting all the tax benefits. So it's like we're not paying any tax on the profit for the first 5 years, and that kind of a modeling is so efficient. And you can do it on a single family rental. You can do it on a 4-unit. I guess you could do it on a 5-unit, but again, that's a different kind of model. So you'd have to do the economics, but it's a cool thing to think about because a lot of stuff going on today, the people are in and out, right? They're very flip and mobile, right? And they want to be able to pivot. And so we just tell them, well, what kind of lease would you like? Well, I'd like a month to month. Okay, we'll do a month to month. It's a little higher. Well, I'd like a 6 months. Okay, we'll do 6 months. It's a little lower. I'd like to do a year. Okay, well, then it's a little lower. You want month to month, you're going to pay an extra premium because you might pivot and be like in Texas, right? Next month, right? So we're going to get a premium for that. And there's a formula to calculate that premium. It's sort of like investing money, if you're taking on more, like when I loan money to people, I loan money to some family and it's like I forgot or got confused that it's really a gift because it never came back. Well, it's sort of like a return on the investment. You're giving a premium benefit, the ability to flip out of there in a month. So that's, we just did our lease renewal, and he went month to month, and he got like a 9 or 10% increase go month to month. Okay, he didn't care. He wants the flexibility to be able to pivot if he wants to. Cool, we're good. Aces, let's do it. And if you think about this, your property is going to outperform any other comp in the area. Financially, you're creating like this bitchin' model that's just going to be like just killing it and crushing it financially, and you're getting the tax benefits and the calculations. I'm putting together the final worksheets that will allow you to just plug in a couple of numbers from the property, and it will tell you all of this cool stuff. And you do want to do rent surveys in addition to rent comps. A rent survey is a very different thing than a rent comp. I mean, how do we do rent comp? We look on the internet and we get the top5apartment.com, blah, blah, blah. That's a comparable, but boy, that's like throwing a dart on the wall. It's not reliable for a purpose of you making a decision financially regarding your money. What you want to do is distinguish you and your property with features and benefits that give you the opportunity to be above the average, right? We're all average, right? I feel like most of the time I have an average day, but when I do stuff, I want to just be a little bit above the average, right? I'm just going to raise my average a little bit. So our rents perform above average, like 22% above average. So a rent survey takes into account features and benefits. And usually it involves a recent appraisal of the property, a square footage analysis, pre and post tax benefit, and then a feature benefit analysis that will allow you to add the premium, right? 0.35 to $1 is a huge premium, right? And when you net it out and you're still performing at 22% above comp, people are looking at you like, how in the shit did you do that, right? Well, like this, it wasn't complicated, right? And so that asset is now working really hard. Look, we work our ass off for our money, right? When we invest it, we want our money to work its ass off for us, right? That's how the game's played. So this is a really cool way for you to get ramped up financially. If you haven't done any financial modeling, just hit me an email, sign up and get on my list. Let me just change something right now because I'm going to give you something really cool here. Give me just a second here. I'm going to scroll a new little thing on the bottom. They call it a banner, okay, a little banner. Get your free asset. We have the experts that will do this, okay? And because you're part of our group, you get it for free, which is totally cool. That was what I negotiated. Yeah, they'll do it, but I want it for free. Okay, we'll do it for free. Okay, but here's the thing. It's limited to 5 properties. So if you have 6 properties, pick the 5 best properties that you want to do this on. Go to the website, drop in your name, and fill out the little form. And it lets you put your contact information. Somebody will contact you from our office first. And then just put in the basic information of each property. Is it SFR? Is it units? How many? 4 units, whatever. And then we'll follow up and we'll get you this asset survey. What is so cool about this asset, because Susan and I do this on every property. What is so cool, it's going to give us some really cool data that will allow us to do a much better job in creating the financial modeling. And since we have a tax attorney that helps us with our tax, I don't even do mine, okay? Like I got somebody that's smarter than me helping us with ours. So then they can take those numbers, right? And they can work through those. And since I understand that language, I know what they're talking about. Then we get like this really cool performing asset with this like very minimal exposure to tax and the financial rewards and the extra income that's coming in and the laundry thing. And I mean, when you just look about it, it's just like, man, I want to go do another one. And we're going to go do another one, right? Probably a 3 or 4 unit. And that's how that works. last thing I want to talk about is vesting. You really should talk to an estate attorney that has some good familiarity with real estate and tax. Because here's the thing, how you hold title matters if one of the parties in a marriage or in the ownership dies prematurely and we don't have things covered. For husband and wife, you can limit the step up in the basis on the date of death to only 50% of the fair market value if you're not holding title as husband and wife, as community property. Joint tenants is right with rights of survivorship, right? Or as community property with rights of survivorship. That little blurb in the title of vesting of the property could mean a huge difference to the surviving spouse in what he or she would have to sell to pay the tax or have some problem with. I mean, it's one of those things that's on the checklist. And if you just do it, then you don't have to worry about it and you got it done, right? So I would certainly educate myself, at least in terms of that. We can't give you the kind of like legal advice. I think we can't do any advice. I can't advise you about counseling or marriage or what movie to see. Our advice has to be limited to only like tax shit. And so that's the only kind of advice I can really give you. Because I'm not even qualified to give all that other kind of advice. And then lastly, your exit plan. How you get out of the property is probably more important than how you get into the property. If you don't have an exit plan, really it's just 2 or 3 simple things. I'm going to sell, I'm going to exchange, or I'm going to transfer. Each of those is going to have a unique financial part driven by a tax part. And so you at least want to know preliminarily what your exit plan would be if you had to come up with one, and then you can start working from there. All right, so cool. I'm inside 1 hour. Awesome. Hey, in San Diego, it's a great day. Yesterday was a great day. I had a little bit of a sniffle because of the allergies. After a rain, it just drives my head nuts, right? You ever have that? It's just like, oh my God. So anyway, drop me an email, visit the site, download a copy of the book for free. Don't go to Amazon and buy it. You can have it for free. If you want the actual book, then yeah, it's like $12 or something. The book is really, it's really valuable. It could save you tens and tens and tens of thousands of dollars. If you do that in the asset survey, you're going to know more than you knew about your property. And then you're gonna know whether it's worth taking another step and looking a little bit deeper, right? And the thing about it, this is all about keeping your money and making that, it's just like you work your ass off for this money. Now start making the money work its ass off for you. I mean, to me, that's not complicated, right? We want to keep it simple. I don't like when things get complicated because then my brain hurts. Anyway, thank you for joining. I hope you got something good out of today. A good takeaway. If you need anything, hit me an email and I'll get back to you and try to help you out. And let's look and see how we can do a little bit more effective real estate gift. It's a great investment, right? Let's make it even super great and let's make some profit.